We all know multifamily syndication and investing in multifamily can be an amazing vehicle, right? It can generate a ton of wealth, create additional income streams, and provide a lot of tax benefits. But like any investment, investing in multifamilies can certainly still have their risks, right? That's the nature of an investment. It always has its risks and rewards. So what I thought I would do in this video is talk about the top 4 riskiest propositions about investing into a multifamily syndication. So whether you're an active investor trying to do this yourself or a passive investor evaluating some opportunities, this is going to be helpful for you to determine the riskiest parts of a multifamily deal. What's going on, guys? My name is Lior and I'm a multifamily investor right here out of Boston, Massachusetts, and welcome to my channel. Before I get into the meat and potatoes of this particular video, super quickly, guys, if this is your first time on my channel, make sure you subscribe to my channel. I put out tons of new videos every single week talking all about multifamily investing into syndications, tips, strategies on construction, investing, analysis, market selection, literally everything in between. So if this is the kind of content you're looking for, make sure you subscribe to my channel. So with that, let's get right into it. And as I said, let's talk about the top 4 risk factors that any investor should evaluate prior to making an investment in multifamily. And again, whether you're an active investor or passive investor, this is going to be useful for you. So let's get right into it with number 1, which is the financial analysis of the deal. Now, this may sound kind of obvious and pretty easy, right? But not all financial and deal analysis of multifamily is made the same. Believe me, I've looked at a ton of spreadsheets from mine, others', and it is not built the same, right? Some of the things that I would definitely be careful for, especially as you're kind of going through different Excel sheets of different opportunities. The big stuff, of course, is you want to look at how realistic are things like rent projections, right? I mean, are they within market? Are they just ultra aggressive for like no reason? That's really a big category, and especially in commercial real estate, right? Where your rents and NOI drive so much of the value and return, that's gonna be absolutely huge. But even smaller things that can have major impact, like rental growth projections, right? I mean, that's a really big one, especially in different markets across the country these days. I've been experiencing staggering rent growth, and I've seen some Excel sheets that have projected those for many years to come, and I'm like, just because it's happened the last the last year or two post-COVID doesn't mean you're gonna happen for the next 2 years, 3 years, 5 years, right? That's a very risky assumption in my perspective. And any other sort of kind of like growth rates, appreciation rates, those kinds of are sneaky rates that can have major impact on the numbers that the Excel sheet spits out. So make sure you're really being diligent, especially on the top line with rents. That's the big one, rent growth rates. Those are going to be super sensitive. Of course, other things like, reasonable construction assumptions, reasonable operating expense assumptions. Those are all, of course, also going to be key, but especially make sure to focus on that top line revenue. Number 2 factor that you really want to evaluate in terms of riskiness of a deal, and this is kind of more if you're a passive investor, but even if you're an active, is the quality of the operational team. Now look, investing into a syndication, investing in multifamily is a very active endeavor. No matter what anyone tells you about how passive it is for everyone involved, it is an active endeavor, especially on the operational and syndication team, right? Obviously, if you're a passive investor, stroking an equity check, that's one thing. But in general, from a deal perspective, there's a lot of moving components, right? Particularly if you're doing any sort of value add, whether it's light or heavy value add, or obviously ground up development. There's a lot of complexities. There's a lot of moving pieces. There's a lot of things that need to be managed, from acquisition to the initial stabilization to the construction and everything in between, right? So there's a lot of moving pieces. So you really want to evaluate, is there a quality operational team that's on the ground that can really take care of these matters? Number 3 factor I think you should definitely evaluate is the market and sub-market selection. Now, I think this has a major impact on overall returns, right? Because, especially if you're investing into a multifamily syndication where it's gonna be 3 to 5 to 7 years down the line where the exit is, right? You're really banking on a strong exit to drive a lot of the returns, right? I mean, if you haven't seen my videos, I've done a lot of videos about this concept where, all the cash flows you make while you hold the building is fantastic, but all the real meat is made when you exit the building, right? So it is incredibly critical to select a strong, not only market, but even sub-market, right? Like a specific neighborhood or even a street, depending on the location, right? Where you can continue to generate continued demand from a tenant perspective, where you can continue to have strong rents, and that will ultimately allow you to exit with strong numbers, right? So really selecting the right market and the right sub-markets is so critical. And you know, that old expression of location with real estate, it's corny and it's overused, but my God, it is like very real, right? Because if you mess this up, you can execute on everything else and your returns are gonna be dampened, like guaranteed. And number 4 factor that I think you should evaluate is the type of debt that is getting placed on the property, along with, and kind of in conjunction with the market cycle. And here's what I mean, right? Because obviously, all markets are cyclical, right? And especially in the last year or so, we've seen a lot of changes in the financial environment. And the type of debt that you place on a property is actually incredibly critical. And it really depends on the terms you're getting for the debt, right? Because what a lot of multifamily investors do, particularly those that are doing any sort of value add projects, is they get what's called some sort of bridge debt, right? Basically temporary debt for 12, 24, maybe 36 months, right? And it allows them to do the renovations and then kind of refinance into more permanent debt. The issue is, right, what happens if all of a sudden you're on bridge debt and it's been 2 years and now you're in a market like this where your interest rates went way up, right? Banking guidelines in general, and banking in general has really constricted. It's a lot more conservative. All of a sudden, it might be way harder to exit from that bridge debt than initially planned, right? So really understanding what are the risk factors associated with the debt that's being placed on the property, along with where you are in the market cycle, is absolutely critical, right? Obviously, the most ideal scenario is you get, some sort of 5 or 10 year debt. Where I operate in Boston, we get a lot of construction debt that is, in the same loan and has 5 to 10 year periods. So we're not super worried. But I know a lot of operators across the country that take these kind of very short-term bridge loans that may be a little bit risky to exit out of depending on the market cycle. So really make sure you understand the profile of the debt that's being placed, the timeline behind it, and kind of make your best judgment off of that. So hopefully that's helpful, guys. Hopefully that kind of gives you some bullet points to think about. Of course, if you have any questions, shoot them below and I will definitely help you out.